Hewlett Packard Enterprises reported their first quarter 2024 on February 29th. Earnings were down nearly 14% year over year to $6.8 billion, which was below management's guidance of between $6.9 and $7.3 billion. Shares were down on the news and after market trading, but miraculously, the shares have rallied 20% since, despite the poor results. An article in Barron's cited that the company had saw an increase of AI-related server orders, increasing their backlog by $500 million. Amazing how the same earnings report can be bad news one day and good news the next. Well, let's look at the details of the earnings report. Revenue was $6.8 billion, down 13.5% year over year, and that's down 8% quarter over quarter. Gross margins were better to 36.4%, showing improvement year over year and quarter over quarter. A good sign. Operating profit was just $525 million, up 3.5% quarter over quarter, but down 11% year over year. That is about 7.8% of revenue. Net income delivered $387 million, down 39% quarter over quarter and 23% year over year, or about 6% of revenue. The only positive was the improved gross margins. Looking at the quarterly revenue since Q1 2022, we can see that revenue has been flat to down since then, with the compound quarterly growth rate of just negative 0.33%. Gross profits growth rate was just 0.5%. Net income was down 3% over the 9 quarters, which is not really a good sign. Looking at revenue by segment, clearly the server segment has been Hewlett's dominant revenue generator, with Q1 2024 revenue of just $3.5 billion, down 24% from Q1 2023. Compound quarterly growth has just been negative 1.77%. The other data, we didn't include the data points to remove the clutter, but we can see the hybrid cloud business has been growing at a 5.2% compound quarterly rate. Also, the intelligent edge business has been growing at a 3.2% quarterly rate as well. Definitely positive signs. The financial services business has been flat, just growing at 0.4%. The server business is obviously HPE's weak spot. Has it bottomed? Let's look at some of the ratios. Earnings per share was just 29 cents. That's down 40% quarter over quarter and 23% year over year. Sales per share were also down by 8% quarter over quarter and 13% year over year. Cash per share was down 12%, but was up 48% year over year to $2.86. Book value is essentially flat at $16.31. Hewlett has a PE of 15.4 compared to the S&P 500 at 27.56, suggesting that the share price is undervalued with respect to the market. The PE growth rate at negative 0.67 is not a good indicator, however. The leverage ratios seem reasonable. The debt ratio at only 0.13, debt to equity at 0.37, and interest coverage of 6. Hewlett has a current ratio of 0.89, a quick ratio of 0.33, and a cash ratio of 0.17. These ratios suggest that there are no short-term liquidity issues at HPE. The return on metrics are not all that impressive. Return on assets of just 2.64%, return on equity of only 7.2%, return on capital employed 1.46%, and return on invested capital 1.13%. Hewlett is clearly underperforming. Looking at the cash flows, operating cash flows down to $64 million. Investing outflows were $740 million. Finance cash flows were up $53 million, but free cash flow to the firm finished at $4 billion, up 39%, a good cash position. Hewlett pays a dividend of 13 cents. That's a yield of 2.84%, growing at 8.25%. The company pays out 44% of its income to shareholders. HPE's enterprise value is $20 billion, with valuation ratios to revenue of just 0.74, 2 times EBITDA, and 1.26 times free cash flow. All of these valuations suggest that Hewlett is rather undervalued. The guidance management provided for Q2 2024 is estimated to be between $6.6 and $7 billion, slightly ahead of this quarter, with earnings per share of just 20 to 25 cents. That gives HP a forward PE of 19. Key takeaways from the report. Well, the company has good cash flow. The PE and enterprise value ratios indicate the company is undervalued. Margin growth is moving in the right direction. The company has good liquidity going forward. On the con side, their revenue growth isn't impressive, contracting, and their guidance for next quarter is only up slightly from Q1. The server business, which is their main revenue generator, is struggling with hybrid cloud and intelligent edge moving in the right direction. Will it be enough, though? Return on assets and return on equity are poor, with HPE not delivering based on those metrics. Hewlett is only trading at 18. We think with respect to free cash flow, the company is undervalued. We're cautious on revenue. However, we are giving Hewlett Packard Enterprises a buy rating. We have no exposure to this company. Like and subscribe.